Welcome to Prekani Trading Networks. Once again, I welcome you to Forex 104 Beginner's Course. Take your time, learn the skill that will pay you for the rest of your life. In order to get started, you need to have one thing in mind. I'm a student always. Do not compare yourself with anyone else's progress. Always keep a winning mind frame and you will do very well in this business. Upon finishing this lesson, you should know the answers to the following questions. Based on code currency, what is a pip, how to calculate a pip, bid, ask and spread, forex trading parameters, risks to reward, types of forex trading strategies. What is based on code currency? A currency pair is a quotation of two different currencies with the value of one currency being quoted against the other. The first listed currency of a currency pair is called the base currency, and the second currency is called the code currency. The code currency, commonly known as counter currency, is the second currency in both a direct and indirect currency pair and is used to value the base currency. One currency will always be quoted in relation to another because you are buying one while selling the other. The price displayed on a chart will always be the quote currency. It represents the amount of the quote currency pair, or it represents the amount of the quote currency you will need to spend in order to purchase 1 unit of the base currency. So for instance, looking at this picture, you're looking at this illustration on your screen. Looking at this illustration on your screen, you're going to see that Euro here is the base currency and USD is the quote currency. So in every currency pair, it's usually like that. The principles are the same. The first currency is known as the base currency and the second currency is known as the quote currency. Alright, most currency pairs, their base currency always has a value of 1. In this case, 1 euro is equivalent to this 1.35052 US dollars at that point in time. This means that if you want to buy 1 euro, you have to pay 1.3505 US dollars. If you want to sell euro, you would want to receive, or you would receive 1.3505 US dollars. So that means the value of the base currency is seen at what? The figure represented by the quote currency. So for you to say you want to sell 1 euro, you'll be willing to accept this value in dollars. So as at this moment, let's just assume that this was what? The value of the exchange. Alright, so that is how it is. So for you to have 1 euro in exchange for dollars, you'll be willing to what? To receive this amount. So this is the relationship that exists when it comes to forex trading. Okay, yes, the value of the base currency is known by how much you are willing to receive. All right, or is actually priced from the quote currency. Now let's talk about pip. What is a pip? Traders often use pips to reference gains or losses. A pip measures the amount of change in the exchange rate for a currency pair and is calculated using the last decimal point, usually the 4th decimal point for non-yen pairs. For a trader to say I made 40 pips on the trade, for instance, means that the trader profited by 40 pips. A pip is actually an acronym for percentage in point. A pip is the smallest price move that an exchange rate can make based on market convention. Most currency pairs are priced to 4 decimal places and the smallest change is the last 4th decimal point. So a pip is the equivalent of 1/100 of 1% or 1 basis point. For example, the smallest move the Euro USD currency pair can make is 0.0001 or 1 basis point. Now, in your trading journey, you will also get to hear things like pipette. Alright, so a pipette is a 1/10 of a pip, and usually the last decimal, which is the 5th for normal pairs and 3rd for JPY pairs in the exchange rate. 10 pips is equivalent to 1 pip. 10 pipettes is equivalent to 1 pip, while all other pairs are quoted in the 4th decimal places. 1 pip is equals to 0.0001. The yen are quoted in 2 decimal places. 1 pip is equals to 0.01. Example, USD JPY. So let's look at this example now. For instance, when you want to calculate your pip, that is to say the movement of price, all right, in Forex or any other assets in the trading environment, you usually have to, once that currency is paired with JPY, it means that you must, and this is a law, you must calculate your pip from the 2nd decimal, and then your pipette is the 3rd decimal, all right, when calculating for yen pairs or JPY pairs. Now, and this law is universal, it's a law, all right, hence trading is concerned. For all yen pairs, you calculate pips from the 2nd decimal place. Do not include the pipette during your calculation. This means that if price makes a move of 98.740, using this as a standard for calculation, all right. So if price makes a move of 98.740, it means that USD JPY has gone up by 1 pip. If price makes a move of 98.720, it means that USD JPY has gone down by 1 pip. Now let's talk about the pairs or the currency pairs that has no JPY. All right, for all non-yen pairs, you calculate pips from the 4th decimal place. Do not include the pip during your calculation, meaning that if price makes a move of 1.35062, it means using this as our standard for calculation. All right, using this particular price as our standard for calculation. So if price makes a move of 1.35062, it means that Euro USD has gone up by 1 pip. If price makes a move of 1.35042, it means that Euro USD has gone down by 1 pip. All right, so you calculate your price movement from the 4th decimal, all right, and do not include the pipette. All right, now you can see this is also another broader example. You can always take a pause and read through this to understand how this pip move. It's just a basic mathematics. Okay, so it means that if USD JPY, for instance, using this now for an example, if USD JPY is trending up, all right, it means that the price is going to move up. And if USD JPY is trending down, it means that the price is going to move down. Okay, so for you to be able to understand the percentage movement of price, all right, or in point, you have to learn how to calculate your pips starting from the 2nd decimal when it has to do with the JPY, and the 4th decimal when it has to do with pairs that has no JPY. Now let's talk about Forex trading parameters. Apparently, there are 3 major things to consider before executing a trade. For you to be a successful trader, you must try to put these 3 things into serious considerations, else you might end up blowing your trading account. Below are the names of these 3 trading parameters that you must know. Number 1 is your entry point. All right, number 1 is your entry point. Okay, apart from market orders, whenever you talk about entry points, an entry point is the level of price at which a trader enters into a trade, whether you are buying or you are selling. Deciding on a Forex entry point can be complex sometimes for traders because the abundance of variables or changes, inputs that move the Forex market. So there are a lot of movement. The Forex market moves per second, you understand. So sometimes traders cannot actually determine the exact price or entry point price they're entering the market, except on market orders. That is when you have the right to determine your entry point price. But when you want to execute a trade, you don't literally know the exact point or the exact price, all right, the market is going to put you in. So these things are some of the things that you need to consider when taking trades. Then another thing is your stop loss. A forex stop loss is a function offered by brokers to limit losses in volatile market moving in contrary direction to the initial trade. Let's say for instance you want to buy expecting that price is going to move up, and unfortunately you notice that price was moving down. So the stop loss helps to protect you so that you don't end up losing all your money. So apparently this means that for you to be able to execute a trade, it means that you have already identified how much you're willing to risk on that trade. That is where your stop loss value comes in place. All right, now let's talk about the take profit. The take profit, or TP, is a type of limit order that specifies the exact price at which to close out an open position for a profit. For instance, let's say you are on a trade and your trades are in profit, and then you have already placed an order to make $100 profit on that trade. So immediately price gets to $100 in value, automatically that means your TP has been taken. Okay, it adds that profit to your current capital. Okay, that is how it works when it comes to trading. So these parameters helps you to control and manage risk, all right, and to also maximize profit. Now you can see it from this picture. The difference between stop loss and take profit means that when you are buying, it means that your stop loss has to come below your entry point. All right, so this buy order is assumed to be your entry point where you enter the market, okay, with expectation of what? Making profit as price increases in value to your take profit. So your stop loss comes right under your entry point, and if you're selling, is vice versa. Your stop loss comes above your entry point. So your stop loss protects you. When you say you are selling, it means that you are expecting that price has to what? Drop or come down or trend in a downward position for you to what? Take profit. So if price starts to go against you by buying, the stop loss is going to protect you. All right, so this stop loss has a financial value. Let's say for instance you're trading with $1,000 trading account, and your stop loss for every trade is $10 or $20. It means that whenever price gets to $20 or $10, as the case may be, your stop loss is going to what? Protect you from not losing beyond that amount that you have stipulated to lose on that trade. All right, so that is one of the things that makes trading very beautiful, and it is very pertinent as a trader to always learn to calculate these things, your risks, before entering trade. Now let's talk about the spread. You're always going to hear things like spread. Now what is a bid and ask price? A bid price is the highest price that a buyer is willing to pay for goods. It's usually referred to as the bid. In bid and ask, the bid price stands in contrast to the ask price or offer, and the difference between the two is called the bid ask, which is known as the spread. Now let's talk about the ask. The ask price, also called offer price or asking price, is the price the seller states they will accept. The seller may qualify the stated asking price as firm or negotiable. Firm means the seller is implying that the price is fixed and will not change. So what is now spread? In forex trading, the spread is the difference between the bid and the ask price, and this is where the brokers charge commissions. So for you to say you are being charged spread, it means that for you to know the value of your spread, whether it is 1 pip spread or 2 pip spread or 10 pipet spread, as the case may be, it depends on what the broker has decided to charge on a particular trade. So brokers charge us spread as a way of getting commission from our executed trades. Is that clear? Now let's talk about the types of forex trading strategies. There are basically 4 types of forex trading strategies, and as a trader, as you improve and get to have more experience in your trading journey, you're going to either fall into one of these categories or at most 2 of these categories that I've mentioned. Now let's talk about the scalp trading. The scalp traders, they target 5 to 10 pips per trade. Usually they use the 1 minute and 5 minutes time frames to carry out analysis. Scalping in a trading style that specializes in profiting off small price changes. Generally, after a trade is executed and becomes profitable, it requires a trader to have a strict exit strategy, so they lock in very small number of pips as many times during the busiest time of trading. So the scalpers are actually those people who don't like to stay long in the market. Once they enter the market and make any little profit, they run out of the market probably because of staying long in the market does not really is not really their way of trading, or they don't feel comfortable staying long in the market as trading involves risks. So they don't want to just be there for long. They just want to enter the market. In less than 5 to 10 minutes, they are out and they are done trading for the day. All right. So we have the swing traders. The swing traders, they usually target 50 to 150 pips per trade or more. Their trade duration is less than a week. Usually it runs between days. All right. So a swing trading position is typically held longer than a day trading position, but shorter than buy and hold investment strategies that can be held for months or years. So swing trading can run for days. All right. It can run for days, can even run for weeks. So a swing trader can decide to take a trade on Monday and close that trade by next week Monday, probably because most people are going to find themselves in this aspect, basically because of the kind of occupation or job they are doing, or some persons feel more relaxed when they enter a trade and don't want to go back to their trading systems. Okay, so swing traders usually they target bigger pips in the market because they enjoy staying longer in the market because they want to actually ride a trend, unlike scalpers. Then we talk about the day traders. The day traders, they target usually 20 to 40 pips per trade using the 15 minutes, 1 hour and 4 hours and sometimes daily time frame. The day trading is speculation in securities. All right. Now, when you hear securities, talking about financial assets, specifically buying and selling financial instruments within the same trading day, such that all positions are closed before the market closes for the trading day. So these people, they only hold their trade within 24 hours. So they usually close their trade before the end of that trading day. They don't carry their trade over the next day. So these are called the day traders. Then let's talk about the position traders. The position traders are those who hold trade for a very long time, and they usually target 500 to 1000 pips per trade. These people can hold trades for months and even years. So they are known as the buy and hold investors. Usually you get these kind of traders. These traders exist commonly for those people who are into the buying of shares or stocks. You buy a particular company stocks and then you wait for it to appreciate in value, and sometimes it takes usually months and years for you to have reasonable percentage growth on your investment. And you can as well be a position trader as a forex trader as well. All right, it all depends on what gives you the most profit as a trader. Now let's talk about risk to reward. This is very essential for forex traders. The risk to reward ratio helps investors manage the risk of losing money on trades. Even if a trader has some profitable trades, he will lose money over time if his risk ratio is below 50%. The risk/reward ratio measures the difference between a trade entry point to a stop loss and a sell or take profit order. Comparing these two provides the ratio of profit to loss or reward to risk. The risk to reward ratio is used by traders to manage the capital and risk of loss during trading. The ratio helps assess the expected return and risk of giving a trade. A good risk to reward ratio tends to be anything greater than 1:3 or 1:3. Let me show you. For instance, let's say as a trader, what this thing means, all this grammar, what it means is this. As a trader, it is very pertinent and very important that when you execute a trade, let's say you're risking $20 on that trade, at least you should target at least your risk to reward should be between 1:2 and 1:3. This helps you to stay ahead of um, of risks. For instance, let's say you're trading and you're risking $100 to make $300 or more, but let's just use 1:3 to explain this scenario. You're risking $100 to make $300. This is going to help you on a losing streak, in the sense that, let's assume that you won 2 trades the first week of trading and you made 1:3 each. That means you have made $600 for risking $100 in 2 profitable trades. And let's assume that next week comes and you happen to lose 3 trades that week. It means that you are still going to be in profit of $300. So this is how Forex should be. All right. Most Forex traders do 1:10. Some do 1:20. Some do 1:30. But these opportunities are always rare. It all depends on what works for you. All right. But doing a 1:1 is not going to help you become profitable over time, because when you take a trade, let's say you risk $100 to make $100. The day you're going to lose that trade, you end up losing your profit instantly in the market. So this is not a professional way to approach the Forex market. So it's usually important to always target 2 times of your risk or 3 times or more, depending on your trading strategy, in order to stay profitable in the Forex market. Congratulations, you've come to the end of Forex 104. Please ensure that you ask questions in line with the context when necessary, as I am saddled with the responsibility to answer you immediately. Remember never to compare yourself with someone else's progress. Take your time and you understand better. So if you have any question, okay, you always come to our support to ask your question, and you are going to get your answers immediately. Thank you for choosing Prekani Trading Networks. We are motivated for your financial elevation. Thank you.